Gold has been on the tremendous rally recently. While the S&P 500 is currently down 8% year to date, gold on the other hand is up 25%, setting a staggering 55th all-time highs in just the past 12 months. So much so that every chai fan auntie, taxi uncle, and probably even you are now wondering, can I still buy into gold now to what big? And will it go up some more? According to a gold bull, the answer is yes, as he is forecasting gold to hit $5,000 in 2025, which if true, it would suggest that there's still another 50% upside from current levels. But hold up, before you rush to buy into gold now, you may want to listen to what I found, because while the future looks golden, the reality may not be as shiny as you may think. Gold is often viewed as a safe haven against economic uncertainty, inflation, market crashes, and even the total failure of fiat currencies. So in a way, gold is this ultimate Milo-tin to protect your wealth. From 1971, when the US abandoned its gold standard till now, the dollar has lost close to 85% of its purchasing power. During that same period, gold has gone up by around the same amount. And if we zoom out to an even longer period, one study titled The Golden Dilemma found that going back to the era of Emperor Augustus, who reigned from 27 BC to 14 AD, gold had been a pretty good hedge for inflation measured by military pay. This shows that gold has historically been a good way to maintain purchasing power. However, with that being said, that same study also found that during normal times, gold does not seem to be a good hedge of realized or unexpected short-run inflation. So, while gold may be a good inflation hedge over the long run, this long run may be longer than an investor's investment time horizon or lifespan. But wait, didn't I say that gold did go up by 85 times while the dollar lost close to the same amounts from 1971 till now? Yes, but this was because I was cherry-picking data to tell you a narrative. If I started from 1980, where there was already high inflation, all the way till now, the price of gold would have only gone up by 4 times, while the dollar still lost close to 78% of its value, which shows that gold isn't really a good hedge over shorter time periods. Now, to be fair, the reason most people buy gold isn't to hedge against inflation, but rather as a safe haven to protect their wealth. In 9 out of the last 10 S&P 500 crashes, gold not only helped protect investors' wealth when markets were crashing down, but in most cases, it went on to deliver strong results. For example, in the 1970s, while the S&P 500 fell by 19%, gold went up by 53%. Or in the 2007 Great Financial Crisis, while the S&P 500 was down by over 56%, gold went up by 25%. The only exception was in the early 1980s, where gold fell by more than the S&P 500. This shows that gold has been incredibly hot during times of uncertainty. Not just that, even during normal times, gold can outperform the S&P 500. For example, over the last 20 years, gold has actually given higher returns than the S&P 500, even when you account for reinvested dividends from the S&P 500. Quick pause, USmartSG has just become one of the most competitive brokerages in town. First, USmartSG now offers trading for US stocks and ETFs at a flat fee of just 88 cents per trade. Second, you can also trade US options with $0 commissions with no minimum charge. And finally, with their zero-cost regular savings plan, USmartSG allows you to enjoy zero fees while dollar cost averaging into eligible US and Singapore stocks and ETFs. To enjoy zero-cost RSP promo, just open up the USmartSG app, go to Trade, More, Regular Savings Plan, and select the stocks that you want to invest in. And here, you can start investing with as little as $100. USmartSG supports automatic e-Giro deductions, which will let you automatically deduct the funds from your bank account. This lets you skip the hassle of manually transferring in every time. You can then choose your preferred investment frequency from every trading day to every month. New users who sign up with USmartSG now will receive up to $202 worth of welcome gifts, including share vouchers, cash vouchers, and free US and Singapore market live pricing when you fulfill the terms and conditions. So sign up to USmartSG using my link down below to take advantage of this exclusive offer. Let's get back to the video. So, does this mean that gold is a good investment for growing your wealth over the long term? Well, not quite. because I'm still cherry picking data here again. If I just shift the starting year from 2005 to 2009, right where the S&P 500 found its bottom during the 08-09 crash, the S&P 500 would have delivered close to 700% returns, while gold gave less than half the returns. When compared to either MSCI All Country World Index or the S&P 500, gold has a very low correlation of around 0.08 or 0.15. This means that gold tends to move independently regardless of whether the stock market is going to the moon or crashing 18 levels underground. You can see this clearer here. Both gold and the S&P 500 are just doing their own thing without any correlation whatsoever. However, even though the correlation is low, it's important to note that it isn't negative, which means that gold won't be the perfect hedge during times of uncertainty. To further add on, roughly 80% of gold's total returns came from just 20% of the time period. This means that unless you are holding gold during that narrow window, you will likely miss out on most of its upside. Sure, the S&P 500 has had its own lost decades too, where it encounters years of poor or flat performance. But unlike gold, the S&P 500 pays dividends, which will continue to deliver returns to investors even when the market is going sideways. But then, what about safety? If gold is a safe haven, surely you could expect gold's value to be a lot more stable as compared to the stock market, right? Again, not quite. From 1980 to 2023, gold had a higher standard deviation of 15.43%, which is higher than both MSCI All Country World Index and the S&P 500. This means that gold has experienced greater volatility than global and US equities over the same period. However, despite the higher volatility, gold has delivered a lower average annual return of 7.6% compared to S&P 500's 10.5%, while delivering almost the same return as global equities. This shows that while gold is more unpredictable, its returns have been quite moderate compared to the stock market, which isn't a great trade-off. Now, of course, no sane investor would go 100% all in into gold. Okay, maybe there is, but that's not the point. So it's not a question of gold versus stocks, but rather a question of would you see any benefit by adding gold to your portfolio? To find out, I backtested how a portfolio of 90% US large cap stocks and 10% gold would perform against a portfolio that's 100% US large cap over a time period from 1980 all the way to now. Interestingly, both portfolios delivered almost identical annualized returns. Additionally, the portfolio with 10% gold had lower volatility, meaning it experienced less fluctuation in its value. As you might expect, during market downturns, the portfolio with gold declined less, which suggests that gold did offer some downside protection. But of course, that goes without saying that during periods of market growth, the gold portfolio would also give lower returns. This suggests that gold can indeed be a good diversifier for your portfolio, as it is not only uncorrelated to equities, it can also help to reduce volatility and provide downside protection during market downturns. But rather than stopping here, I wanted to take this one step further and compare gold to treasury bonds. After all, bonds are also considered as a safe haven asset, and in many ways are much safer than gold since they are backed by the government itself. So here, I've added a third portfolio which has a 10% allocation in the short-term treasury bonds. And this time, the 10% bonds portfolio slightly outperformed the 10% gold portfolio, while experiencing lower volatility. This suggests that bonds are actually a better asset class to use if you wish to diversify your portfolio. However, some might argue that the US treasuries may not be so risk-free in the future, given that we are now entering a new world order. With rising geopolitical tensions, Trump's tariff-heavy policies, as well as out-of-control US government deficits, the world could gradually accelerate the ongoing trend of de-dollarization. Combine that with the growing concerns about the long-term sustainability of the US dollar as the global currency reserve, the traditional safe haven status of treasuries could start to come under pressure. So, if you want to hedge against that possibility, gold might be worth considering, especially in the event of a currency debasement, where the US dollar could one day lose significant value or its status as the world's reserve currency. Which brings us to the next question. Given that gold has rallied by so much recently and has even gone hyperbolic, should you even consider buying gold now? Or is it better to wait for it to come back down first? Now, obviously, I don't have a crystal ball and can't predict the future. But here's an interesting chart to consider. This chart tracks the S&P 500 to gold ratio. It tells how many ounces of gold it would take for you to buy the S&P 500 on any given month. A high ratio means that the S&P 500 is expensive in relation to gold. This usually signals a period of strong economic growth, low inflation, and high investor confidence in equities. Whereas a low ratio means that the S&P 500 is cheap in relation to gold. This typically indicates economic uncertainty, high inflation, or market downturns as investors seek the safety of gold. What you will notice is that this ratio typically oscillates between its highs and lows over the long term. And right now, the ratio is at 1.8, which suggests that gold is still cheap in relation to the S&P 500 if we judge it based on its historical average. Now, of course, just because it's cheap doesn't mean that gold will confirm go up. Instead, this sharp turn lower just means that there's an increased investor demand for safe haven assets, such as gold. That's why several analysts believe that if this trend continues, gold will continue to go higher. For example, JP Morgan predicts that gold would reach $4,000 by Q2 next year. Another analyst thinks the same too, while Goldman Sachs thinks that gold could go even higher to $4,200 by end 2025. And of course, not to forget that ultra bull guy who predicts that gold will reach $5,000 by end of this year. Will that really happen? Time will only tell. But given that the current trade war doesn't seem to be cooling off anytime soon, and if anything, it looks like tensions could drag on for another 2 to 3 years, that kind of prolonged uncertainty could weigh heavily on the global economy. And historically, gold tends to thrive in this kind of environments. But then again, given how fast Trump flip-flops, I wouldn't be surprised if the US suddenly announced a trade deal with China, like tomorrow. Whatever the case, given that gold has shown to be a good asset class for diversification, it's definitely not a bad idea to have some exposure, just to help cushion your portfolio during periods of uncertainty, with some analysts like OCBC suggesting a 5% allocation. But in order to reap its benefits, you will need to be able to hold on to it for the medium to long term. Personally, I'm comfortable holding a portfolio that's 100% in stocks. With a long-term investment horizon of at least 20 years, I'm prepared to ride out the volatility. And history has shown that over the long run, stocks tend to outperform gold. If anything, I look forward to any further drawdowns as they give me more opportunity to accumulate more at lower prices. And if things really do go south, I still have my CPF as a safety net. Then, when the market eventually recovers, I will also get to capture the upside as well. That's just my take, but I would love to hear from you. Do you think gold is a good investment? Let me know in the comments below. Anyway, that's all for this video. Like, share and subscribe as I'll be posting new videos every week.